Well, it's hard to believe Labor Day is a month in the rearview mirror already. I hope you and your family had a fantastic summer. It certainly goes by quick. For me, it was one of the more memorable ones I remember with my family. It was slow, lots of time with friends and family, and where we were, the weather seemed to be very cooperative. And hopefully, you had a fantastic summer as well. Thanksgiving is upon us, so that means that it's time for our third quarter market update for the 2024 calendar year. Markets continue to be strong in 2024, and the third quarter was no exception. I'm just going to share the screen here for everybody to see what the numbers look like. So we'll get started here. I'm just going to hide a couple things. All right, let's have a look here. So as we look into the calendar year, 9 months in, the Canadian market continues to be double-digit returns. Year to date, the TSX up 14.5%. The US market continues to be the dominant market. The S&P 500, the most widely followed index in the world, up just a hair under 21%. The tech-heavy NASDAQ continues to be strong, up 21. Trailing number on it, 37% for the last 12 months. Dow Jones Industrial Average, it's only 30 stocks. It's not really an index that we follow that closely because of that, but up 12% for the year. Internationally, Chinese market has been strong, year to date up 12. Germany's up 15. Italy double digit at 12. Japan, the Nikkei, up 13. But the big one down here is India. Looking over here at commodities, gold's trailing 12 months a little bit softer. However, natural gas has been the opposite. Year to date, natural gas prices are up almost 55%. Gold and silver strong. Copper continues to remain strong. And lumber basically has been no change. But the real story, and we continue to talk about this a lot because it is really distorting performance in the United States and the S&P 500 index. What we're looking at here, this chart is a breakdown of what's referred to as the Magnificent Seven. So those are 7 large dominant stocks that make up a very large portion of the S&P 500 index. They include names like Apple, Amazon, Microsoft, Nvidia, Facebook, Tesla, and Netflix. Year to date, those 7 stocks are up 35%. And that's that green line here. That's the performance of those 7 stocks. The other 493 stocks that make up the line, that's them here, up just 11%. So combined, the index is up 21% year to date. But without those 7 names in the index, it would have been only up 11%. So the S&P 500 index is what's called a market-weighted index. So for larger companies, they have a larger weighting in the index. Just so happens that those 7 stocks are behemoths. So they have such a large weighting in the index. And that's what it's showing here. Those 7 names represent 36% of the index. And they're trading at, little rich valuations. Historically, the top 10 stocks have traded somewhere around 20.5 times earnings. They should trade at a premium to the rest of the market because they are faster growing businesses. However, the remaining 490 stocks are trading on an average of 15.7 times earnings, which gives a current blend of them all of 21.5 times earnings. Historically, if you look at the long-term averages, they're trading at slight premiums for the market as a whole. Here are those names that we were talking about and just how large those businesses are. Apple, as an example, in Canadian dollars, has a valuation of $4.6 trillion. The entire Canadian stock market is about $3 trillion. So that means Apple, Nvidia, Microsoft, and almost Google are all larger than the entire Canadian stock market. The other big names there are Amazon, Meta, which is Facebook, Berkshire Hathaway, Broadcom, Eli Lilly, and Tesla. Huge, huge companies. Every one of them. Tesla's the smallest company at $1 trillion on that list. But surprisingly, that's not unusual when you look at markets around the world. So let's look at the Canadian market here. We've got roughly the top 10 stocks, the top 10 weighted stocks in the Canadian index represent 40% of the index, and a little bit more than 40% of the earnings related to that index. So our next chart here is just a breakdown of what those Canadian companies are in comparison. So the largest company in Canada is Royal Bank with a valuation of 235 billion, followed by TD, drops all the way down to 152, Shopify, 142 billion, but then you see Enbridge, Brookfield, Canadian Natural Resources, CP Rail, Thomson Reuters, Canadian National Railway, and Constellation Software. But by the time you get to the 10th stock is under, even the 9th stock is under $100 billion in terms of size. So Canadian companies are much smaller than our American counterparts as a whole. Interest rates have started to come down. You know, central bankers have started to cut rates. That's generally a good indication for stock market performance. And that's what this shows here on the S&P 500 index, looking at the last 6 times that we've cut rates south of the border. 1989, 1984, 2019, and 1995, 24 months after the first rate cut, the markets were all higher. 2 instances, they were lower, 2001 and 2007. Both of those were dramatically different backdrops. 2001 was obviously what was coined as the tech wreck, and 2007 was the financial crisis. Another question we're getting a lot of right now, as you look at your statements, they're the highest they've been at. And market performance has been really, really strong, driving the values of those accounts up. We're getting a lot of questions that relate to, geez, Chris, the market's trading at an all-time high. I've got extra money to invest. Should we be putting it to work? The science says you should. And what this shows you is actually maybe surprising to most. Investing at a new all-time high in the market or versus any day. Like so far this year, in 2024, 9 months into the year, there's been 43 new all-time highs. 6.6 of the days of trading, the market is closed at a new all-time high. And the percentage of all-time highs that's acted as a new market floor, 30% of the time. Over here is exactly demonstrating that. Where if you were to invest new money at a new all-time high, 3 months later, typically 2.3% higher. A year later, 2 years later, 2 years later, 3 years later, and 5 years later, versus just picking any random day. There's a lot of momentum. Over here, just look at this. If you had never, pulled your money out when the market was making a new all-time high, you would have missed all of the growth of the market. So there's a very compelling reason to invest near an all-time high. The backdrop continues to be strong. And as what we're looking at here in this chart is kind of what are expectations for forward earnings of corporations. In 2024, looking at the S&P 500, that basket of stocks, the basket of earnings represents about $241 for that unit. It's expected to grow by 15% in 2025 to 277. And again, future earnings growth in 26 of about 12% to $311. Earnings are the number one driver for the performance of a stock. Ultimately, it's quite simple. The more money that a business generates, the more valuable that business is. We really like to diversify portfolios across a broad range of stocks. And this is a really good chart to show you why. This is about, the single stock volatility and looking at the total market returns. Calendar year 2023, just last year as an example, the S&P 500 posted a gain of 24% on the calendar year. Out of those 500 stocks, though, even though that basket appreciated by 24%, there was still 126 out of the 500 stocks that declined by 5% or more that year. That means roughly over a quarter of the stocks in the index actually had a negative rate of return in calendar year 2023. So broad diversification is important. Looking at the consumer south of the border, their balance sheet still looks strong. However, there is a little bit of weakness starting to come in, which is why interest rates are coming down. Overall, the U.S. consumer has a total assets of about $185 trillion versus total liabilities of about $21 trillion, with the bulk of it obviously being mortgages. Largest component of assets south of the border are financial assets at 42%, followed by their homes at 28%. But what we're seeing here following COVID and the rise of interest rates, the debt service ratio has crept up to about 10.1% as a percentage of disposable income. We're also starting to see, some delinquencies in terms of auto loans and credit card loans starting to creep up a little bit. So that shows you that economic activity is weakening slightly south of the border, which is why interest rates are starting to come down. Consumer spending, though, and saving is pretty decent. This is a very good chart to demonstrate what caused the inflation globally. And this is consumer spending over here. And so this is kind of the beginning of COVID right in here. And following that, durable goods year over year from 20 versus 19 were up 7%. Non-durable goods up 3%. Services dropped off considerably, down 6%. And that was largely due to COVID restrictions. But with COVID relief money, people staying at home, consumers spent a considerable amount of money in 2021. Look at the growth of durable goods sales, 17% year over year. So they grew by 3%, grew by 7%, then on top of that grew another 17%. Non-durable goods up 9% and services up 7%. This massive influx in spending, so much money chasing too few goods is what has caused inflation, and we're working that on the way down by that was the whole point of increasing interest rates, to kind of slow the economy down a little bit. But when you look over here, consumer saving is continuing to rise. Year to date, we're at kind of 5.2%, below the long-term average of about 8.5%. But you'll see this big spike. That was COVID. Nowhere to go, nowhere to spend the money. Consumers saved far more money during COVID than they spent, the bulk of it. We often talk between value stocks and growth stocks. And this is a good chart to show you. Those green bars here, these are what are considered growth companies. They're in the communications area, technology, consumer discretionary, and healthcare. The value stocks would be the gray bars here, which obviously financials, energy, materials. But corporate balance sheets are strong. And if you look at those growth names in particular, they're sitting on a lot of cash as a percentage of their current assets. Communication services the higher, with almost 50% of their current assets in cash. But what's really interesting is over here. The reason why growth stocks continue to do well right now is they are making, a considerable investment in their future. And what this chart shows you is those four growth sectors are spending money, their CapEx, their R&D, at a rate higher than what the average has been over the last 10 years. So they're accelerating investment in their industries. However, when you look at value stocks, they're below. Energy is 6% versus its long-term average of 10%. Same thing as industrials. So value stocks right now, they are not making the same investment in R&D and CapEx that their growth counterparts are. Value stocks continue to remain cheap compared to growth stocks, as this chart shows you here. When you look at the long-term average on price-earnings ratio, their long-term average is about 14 times earnings. They're currently trading at about 17 times. But growth stocks normally trade at 21 times earnings as a basket, and currently are trading a little bit closer to 29%. And dividend yields are still reasonable. Interest rates also play a bit of a role in this as well. What this shows you is when interest rates are above 5%, historically, value stocks outperform. And interest rates have been above 5% for 50% of the time since 1979. However, you go back over to the other side of the chart here, when interest rates were ultra low, 0 to 2%, growth significantly outperformed. However, we've only since 1979, and it's only been recently, have interest rates been at those levels, representing only 11% of that time. Looking at international valuations and dividends, international stocks compared to their US counterparts are trading at a deep, deep discount. International stocks historically have always traded at a discount, with a few minor exceptions to the US. However, they're now beyond 2 standard deviations, representing a 36% discount. In terms of value, the current price-earnings ratio on the S&P 500 is 21.5 times. And they're looking at the all-world index, excluding the US, so the various stock markets around the world, excluding the US, is trading at only 14 times earnings. And the dividend yield is considerably higher, 3.1% on international stocks versus an average of 1.4% in the US. Consumer confidence is with regards to the stock market, even with as well as this year has done to date, following the heels of 2023 being a good year in the market, sentiment is still below the long-term average of 84.5. And we're coming up, obviously, in less than a month. We've got a big election in the US. The economy always seems to be the topic that's brought up more often than not. What this chart shows you is, depending on which party is in power, it's amazing how much a Republican-led White House in this era was the Bush. This is a percentage of Republican or voters that lean Republican who view the economy as being good or excellent. However, under Obama, under Trump, and currently under Biden, 41% of Democratic voters feel the economic activity is good or excellent, and only 10% of Republicans feel the same way. So that kind of brings us to the conclusion of our update here. I'm going to stop sharing my screen and kind of go back and have a little chat about what I kind of think is going to happen going forward. The market has had a really strong start to the year. In fact, arguably a good year already, 9 months in. That being said, we do have a US election that I think is going to be much closer than most people think. And I think there could be a lot of noise around that. Tensions are heating up in the Middle East as well. So there are a few things that are on the back burner of the stove, if you will, that are likely to get moved to front of the stove. Some noise. It's been a while since we had a pullback in the market. I don't want to change portfolios. I think how you're positioned is where you should be. But I'm just saying that volatility could increase here in the fall a little bit. And my cautionary advice would just to prepare for that. It's been pretty easy so far, but it could be just a little bit more of a bumpy ride this fall. And so I just cinch up the seatbelt a little bit and ride through those bumps. By all means, if you have any questions or concerns, please feel free to reach out to me or any members of our team. And in closing, we've had a couple of questions if we would be willing to share our content, monthly content that we do with you, or valued client with a friend or family member of theirs. Absolutely, for sure. So if you know somebody that you would like to receive the same information that you are receiving from us on a monthly basis, just reach out to us and we'll certainly add them to our list as well. All the best in the fourth quarter of this year. It's hard to believe, but the holiday season will be here before you know it. So take care and reach out if you have any questions. Thanks for taking the time to watch this update.